case of Lebanon. And it's facing really a perfect storm, facing four crises. There's a political crisis. The country is divided upon itself for many reasons. There's a public debt crisis. There's a balance of payments and currency crisis. And there's a banking crisis. Now, this is highly unusual. If you look at crises in other countries over the past 30, 40, 50 years, you usually have a debt crisis or a banking crisis or a balance of payments crisis. The combination of all those three is highly unusual. There's only been 2% of cases that have been there, which makes it more problematic to deal with. But let's explain how we got here.
Good morning from London, and welcome to this OMFIF seminar on overcoming debt crisis in emerging markets, prospects for sovereign debt restructuring and access to financing. My name is Danai Kyriakopoulou, I'm OMFIF chief economist, and it's my pleasure to welcome today two distinguished speakers to be with us. So we have Nasser Saidi, former Deputy Governor of the Central Bank of Lebanon and Minister of Economy, and also Hippolyte Fofak, Director and Chief Economist of the African Export-Import Bank. Very good morning to you both, Hippolyte joining us from Cairo and Nasser from Dubai. Very nice to have you with us.
Good morning.
Good morning.
Hello. So emerging markets, what is different today from previous crises? We have very high levels of debt now compared to the past. We also have a very different mix of who the debt is owed to. We have a different mix of creditors. We also have a shock that is hitting emerging markets in different ways. Shock to tourism that many are depending on, also commodity price shocks. And we are seeing prospects for defaults, for needs for restructuring from emerging markets, from Ecuador to Zambia to Rwanda, from Argentina to Lebanon. It's something that's really affecting emerging markets all around the world. And institutions such as the IMF, such as the clubs of creditors, bilateral creditors, the G20, are looking for ways to do that in an orderly way, but also granting immediate assistance where it's needed. We've seen capital outflows from emerging markets already at record levels compared to previous crises over the months of March and April. We've seen continuous capital outflows, and we're also facing a much more financially globalized world. So how do we get out of this? Nasser, let's start with you. And Lebanon has seen better days since you were in charge of the economy, and it's now gone through its first sovereign restructuring. And we are in the middle of this now. So tell us, how did we get there? Where are we now, and where do we go next?
Right, it's interesting, I think, to start with the case of Lebanon. And it's facing really a perfect storm, facing four crises. There's a political crisis. The country is divided upon itself for many reasons. There's a public debt crisis. There's a balance of payments and currency crisis. And there's a banking crisis. Now, this is highly unusual. If you look at crises in other countries over the past 30, 40, 50 years, you usually have a debt crisis or a banking crisis or a balance of payments crisis. The combination of all those three is highly unusual. There's only been 2% of cases that have been there, which makes it more problematic to deal with. But let's explain how we got here. The first thing to note is that the country has been running large fiscal deficits for the past 25 years. If you recall, Lebanon went through a civil war and started reconstruction back in 92, 93, at the time at which I was at the central bank and then became minister. And the large fiscal deficits initially were meant for reconstruction spending. But the country got hooked on debt, and average budget deficits for the past 10 years, since 2010, have been about 8.5%, 9% of GDP. That is enormous. And of course, this has led to a large buildup of debt. But that was not the only contributor. The country has also been running very large current account deficits, averaging 24% of GDP over the past 10 years, since 2010. And At the same time, the central bank tried to maintain a fixed exchange rate, a peg to the dollar, since 1996. But of course, there's an important lesson here, which we will get to. You cannot simultaneously have an open capital account, fixed exchange rates, and independent monetary policy. The central bank was trying to finance the budget deficits, but also started financing government. Large buildup of debt, high interest rates. So we're now running at a debt to GDP level of 175% of GDP. That's just about number 3 in the world. Debt service, interest, before the restructuring was eating up something like 60% of government revenue. So in effect, you started borrowing even to service debt. What helped Lebanon was the Lebanese diaspora, the expatriates all around the world that financed Lebanon. So although debt was building up very rapidly, what happened was that remittances financed much of the budget deficits and the current account deficits. Because although Lebanon went into the markets and now has public debt, external public debt, which represents about 30% of the total, the rest of the debt is domestic debt. And again, this got financed really from portfolio flows, mainly from Lebanese outside. So an interesting feature in the case of Lebanon is 2 things. First, much of the debt is in Lebanese pounds and is Lebanese debt. Only about 30% or so is in foreign currency. Second, much of the debt is owned by Lebanon itself. So it's the exposure of the banks. So the banks, the commercial banks in Lebanon, are exposed to the sovereign as well as the central bank to the tune of around 70% of their assets. So in effect, the flows came from remittances through the commercial banks. And then the central bank raised interest rates to attract the deposits at the banks into the central bank and then use those deposits to finance the banks. The net result of that is that you have 3 interconnected balance sheets. The government's balance sheet, largely insolvent. The commercial bank's balance sheet, because much of their assets are to the sovereign and to the central bank. And the central bank, which also holds government debt, something like 60% of the debt, right? Domestic currency debt. So those 3 balance sheets are interlinked. And unlike other cases, say in Argentina or others, where you're having to restructure and you're talking to foreign creditors, here you have to talk not only to foreign creditors, you have to talk to domestic creditors as well. So you have really 3 types of restructuring. So it's not a classical restructuring. You have 3 types of restructuring that have to take place. You have to restructure the public debt, including external debt, and I'll talk a little bit about how that is taking place. You have to restructure the banking system because debt has now declined in prices. So we're talking about a potential haircut of around 80%. So if you look at prices in the markets on Eurobond for Lebanese debt, it's now running around 18 to 20 cents on the dollar. So whoever is holding the debt has got a large loss, and that includes Lebanese banks. So you have to restructure the banking sector itself. The third thing that you have to restructure is the central bank, because it borrowed from the banks and is no longer able to repay because it was financing current account deficits and the money left the country. And it financed government, and government is no longer able to repay. So you have 3 restructurings which need to take place. This again is unprecedented. So what has Lebanon done? It found out, of course, a new government was formed a few months ago, 105 days ago, 110 days ago. Facing a situation in which growth is declining. We've got a deep recession of around 15% of GDP, losses of revenue, and this accumulated debt and debt service. So government decided, quite correctly, that it would suspend payments and would go into restructuring of its debt, which it announced early in March. There was a big bond maturing, 2.1 billion, on the 9th of March. They suspended payment on that and said, we're open to restructuring talks. So those restructuring talks are with effectively foreign creditors, and with some Lebanese banks, including the central bank, who also own a portion of those Eurobonds. The second thing that the government said was that we're going to present a rescue and restructuring plan, which they've done. Under that restructuring plan, they're talking for a debt haircut, a public debt haircut, both on external debt as well as rescheduling and maybe a haircut or restructuring domestic debt as well. This then raises the question of who's going to bear the burden. Because if you're having these debt haircuts for external debt, it's external creditors by and large, and a small proportion for domestic creditors holding Eurobonds. But for the domestic debt, who's going to bear the burden of the restructuring of the debt? Because that's a big loss to the banks. The banks are saying, well, thank you very much. I don't want to pay it. I mean, the shareholders of the banks are saying, thank you, I don't want to pay that. Even though the management of the banks and the shareholders agreed to finance the central bank, right? They thought, well, I'm giving my money to the central bank, so it's safe there, right? What could be safer than giving your money, supposedly very liquid, to the central bank? And they want to pass it on to the depositors. And the government said, well, that might be a nice way to do it as well. So we're going to have a haircut on deposits. But if you're going to have a haircut on deposits, then you run the big risk that you no longer have access to all the remittances and the portfolio inflows of the Lebanese expatriates who've been financing you all along. So the issue of market access is a bit different from what usually happens to emerging markets when they're going to default or want to restructure, that is access to foreign markets. Here, the access to foreign markets is access to the Lebanese diaspora, as well as the international investor community. And this is important because Lebanon has never defaulted on its debt. It's always satisfied its obligations. So this is the first time we've had anything like this in the country.
Unprecedented times for Lebanon then.
So they presented the plan and they said, we're going to go for getting funding from the IMF. And they've started negotiations with the IMF. And a couple of weeks ago, these are likely to take a bit longer than usual because the IMF is saying, if I'm going to be providing any financing for Lebanon, I need to make sure that there is debt sustainability, there is fiscal sustainability, and I also want to have in place a Capital Controls Act because I don't want to fund and then see the money exit the country. So the negotiations are still ongoing. In the meantime, the restructuring debt negotiations with external holders of the debt all are waiting to see what the results are of the IMF negotiations. So those two will go together. So effectively, your external debt restructuring negotiations are waiting for the outcome of negotiations with the IMF. So at the moment, you might describe it as a disorganized restructuring, but the creditors are waiting to see what will come out from the IMF. The prospects are not very positive because the IMF is going to require many reforms. If you think about the numbers I mentioned in terms of large sustained fiscal deficits, large sustained current account deficits, those require structural adjustment and not simply an adjustment of monetary policy or exchange rate policy and fiscal policy. In the meantime, of course, the exchange rate has depreciated very rapidly. The central bank effectively has run out of reserves and is no longer able to support the peg. And this, of course, complicates matters because you've got the depreciation of the pound, of the Lebanese pound, which means you've got inflation happening, and therefore it affects the value of the debt on the books of the banks as well. So that's why I call it a perfect storm. And the horizon is not very rosy at the moment.
Thank you very much, Nasser. I think you put your finger on a lot of important topics that we can discuss today. What is the source of the debt crisis that we're seeing? How is this perfect storm emerging? What are its characteristics? Is it a fiscal crisis, current account, debt crisis? How are all these elements coming together? Also, who the debt is owed to, and what are the repayment terms? You said 175% of GDP. What does that mean? What is the actual debt servicing costs that different emerging markets are facing, and how can we draw lessons from Lebanon also for other countries? Also, the process of restructuring, whether it's organized, whether everyone is going to try and get the best deal for themselves, how can we have a framework around that? Who bears the burden? I think this is an important question. And also the question of conditionality, which you mentioned as well. What are the reforms that IMF and other creditors may impose on these emerging markets to offer such restructuring terms? So I think there's a lot of issues to grapple with. Is a cocktail, as you described it. But we'll have time for this in the discussion. Let's move to Hippolyte now. Of course, the mix in Africa is very different. Nasser mentioned how in Lebanon it's a lot of the debt is held domestically. Only 30% is external debt. We're seeing a very different picture. In Africa, we're seeing big hits, also a lot of commodity producing countries and exporters, and a big role for bilateral creditors as well, the increasing role of China in the country. But from your perspective, also as looking at research, you're the chief economist of the African Export-Import Bank. What are the sources of this debt in emerging markets that we're seeing? How does this play with the financial globalization, the structure of the world economy? How is it now compared to previous crises? And also looking at Africa specifically, where do you see the big risks and how do we get out of these? Thank you.
No, thank you very much, Adena. I think, quite frankly, Africa is, when I hear the minister describe Lebanon, it's a perfect storm. And what we have today is the reason why we should avoid getting deeper into where Lebanon is. We should actually mitigate the risk of moving from a normal crisis into a banking and financial crisis, because otherwise the stimulus become like injecting the resources into a financial black hole. I think that's where Lebanon is, making it very difficult to transition out of crisis toward a more sustainable recovery path. But I felt that before I even begin to answer your questions, that perhaps I should provide an historical perspective of debt crisis, restructuring, and default. When you look at that historical perspective, I look at a document of 13, 14 pages on listing the debt crisis. And out of that list, I was surprised to see that essentially we had about, let's say, 6 pages on the Americas, maybe 9 cases in the US alone. We had about
how many of these pages are Argentina, Hippolyte?
Argentina in America was a big part of it, definitely. You're perfectly right. And we had about 3 pages to Europe, interestingly, 2 pages on Asia, and then 1.5 page, maybe 2 pages in Africa. That was distribution in terms of coverage. And then the first instance mentioned in the 19th century was actually France in 1912. And as a result of mismanagement, high military expenditure, you can see the exogenous factor driving debt crisis. A second case, which I also highlighted, very interesting, was Germany in 1932, whereby after the Versailles Treaty, it became difficult for Germany to honor that commitment. The UK and France were generous, actually accepted restructuring, but the US Congress was very much intransigent. We know the outcome. Another case relevant to Africa, it's Russia in 1998. When commodity price collapsed in Russia, Russia had no other option but to ask for moratorium on payment of external liability and commitment. And we have Japan and the UK and IMF crisis, 1979. So this is the historical perspective that we see. And what is interesting, when one actually analyzes the main drivers, whether it was in the 18, 19, early 20th century or today, things have not changed very much. You still have as a main driver reliance on commodities as an important factor, the issue of macroeconomic management or mismanagement in the case of Lebanon, as we heard, and exogenous factors such as war, humanitarian crisis are also very important and critical factor. And then increasingly more recently, the overissuance of bond, reliance on the market to actually cover sovereign, to mitigate the risk balance of payment crisis. The review actually suggests that the debt distress leading either to restructuring or default have not really changed. And to a large extent, they are still driven by the same factor, inability of bondholder and government to chart an orderly path and predictable path, as we see in the case of Lebanon, and intransigence of a number of bilateral and sovereign creditors, as we saw in the case of Germany, and the diversity of creditors with multiple objective functions, which makes it very difficult to achieve an orderly and consistent approach to debt restructuring. And then the issue of currency of lending. I think on the currency of lending, as you mentioned, the fact that most of Lebanese debt is in local currency actually reduce the issue of interest rate exposure, which tend to actually make the debt burden even more difficult to carry. So although there has been growing concern about debt sustainability in emerging market economy in recent years, concern now exacerbated by the pandemic, as you suggested in your opening remark, the global distribution of sovereign debt is still very much heavily tilted toward advanced economies, advanced and emerging market economy. In particular, the US, Japan, and China, and few European countries are topping the list. And we look at that list closely, African countries actually account for, Africa as a whole, account for less than 1% of aggregate sovereign debt globally. Although the region accounts for about 16% of the world populations. So they are still very much at the lower end of that league. Notwithstanding that encouraging statistics, the pressure on balance of payments has been increasing, even more so as a result of the pandemic, in part because many countries, as we mentioned earlier, are still very much dependent on commodities. So the vulnerability of the region to commodity shocks has been very strong. And in fact, it's important to stress that every time we've seen a major shock in the global commodity market, the impact on African economy have been almost direct, one-to-one. And it's quite interesting, just a few years ago, Angola was the best destination for investors. Sound financial management, best indicators in terms of both fiscal, monetary, and then came the end of the commodity super cycle, 2014-2015. The country is yet to recover. I think the deficit are to the roof, and the debt has reached significant high level. And we looked recently at the extended debt service payment as a share of export earning. I think the country is actually bleeding in terms of servicing that debt. And the same can be said about other commodity and oil exporting countries. If you look at Guinea Equatorial, for instance. Another important drivers of Africa debt that we should also stress, it's what we call the zero lower bound effect, which has led many countries to actually capitalize on improved macroeconomic management to have greater access to capital market. And if you go back to 2006, for instance, we had only about three African countries going to capital market. It was largely South Africa and to a lesser extent, Morocco and Tunisia. 2006. Today, more than 21 countries have actually gone to the capital market. And in 2018 alone, they raised about $13 billion, euro or dollar denominated debt. In 2019, they're about $27 billion in 1 year. So these are some of the major drivers of increasing external liability across the regions, which compared to the HIPIC era has shifted the distributions of Africa external debt, external liability, more toward private and bondholder, unlike the pre-HIPIC, which were essentially largely concessional, bilateral and multilateral debt. Another important driver, which is in this case an exposure, is the issue of debt denominations. Unlike Lebanon, which is essentially largely in local currency, in the African case, market obliged is essentially increasingly more toward dollar and euro denominated debt, which raise another risk going forward. What happens when we enter an era of interest rate movement? Yet another important drivers of debt within the region, beside the currency of issuance, it's in my view, and this is very important, the fact that the risk perceptions allocated to Africa tend to be overly inflated. In other words, when you look at the rate of bond issuance in Africa on average, compared to a country such as Greece, as we mentioned, or Italy for that matter, and the gap is huge. So that risk perception tend to have implications in terms of cost of borrowing, which translate into debt servicing and sustainability issue. But I think the key issue now, since we now are facing what the minister called the storm is here, it's not tomorrow. And we've seen that the pandemic will actually exacerbate the debt pressure and the pressure on balance of payment. And many African countries have gone to the IMF and the World Bank, and have also contacted other bilateral creditors to raise more resources. So there is definitely a trend toward even increasing external liability, even more the stock in 2020 and 2021 going forward. It is again that background that there's been a lot of constructive engagement at a global level to begin to help African countries or the low-income countries create more fiscal space to address the fallout, social fallout from the pandemic. We've seen a number of proposals on the table, and the debt service suspension initiative, which is coordinated by the IIF, the International Finance on one side, but a number of countries are pushing for an even, instead of looking at just 6 months or up to 2 years, to give a more longer period, while some which are less concerned about the market, because there are two tensions. Countries which have access to capital market are very concerned that debt relief could undermine ability to continue to have access to market to sustain their growth. And this is Democrats who are rating agencies on their head. And then there are countries which are saying, no, debt service suspension is one thing, but we are calling for actually debt forgiveness to a certain extent. So that tension is there. In the middle of that tension are what we call the changing profile of Africa debt, which have shifted more toward the commercial and the bondholder, and it was much easier in the HIPIC era to reach a consensus given the uniform distributions, almost uniform distributions of a debt holder. In this particular case, we have the private sector and the bondholder, which is willing to work with bilateral on the concessional side to achieve an orderly transition to a debt restructuring. So this is a major challenge. The emerging consensus has been, how do we move forward? Let's bring in the private bondholder, the commercial on voluntary basis, and which will make it very difficult to have a more coherent framework for debt restructuring. So let me stop here for now.
Thank you very much, Hippolyte, for that historical background as well. It's very important to put things in context, but also for the various issues that you raised, that the different profiles of African countries, the particular issues that they're facing with external creditors, and also with the economic shocks that they are seeing, especially exporting countries. I had some follow-up questions, but at this stage, as we're moving to the discussion part of the seminar, I'd like also to invite the audience to send through their questions that I can then pose to you. So you can do that through the chat function of the system here, or you can also email questions to inquiries@omfif.org, and they will be passed on to me. But perhaps I can start with a question to both of you, actually, of what do you think, how do you think emerging market policymakers should be thinking about the trade-off between achieving restructuring and relief in some cases now versus the risk of the reputational risk that they may face and having market access tomorrow? And I think, Hippolyte, you also mentioned a little bit about the importance of access to capital markets, domestic and foreign. And of course, capital markets are not as developed as we would like, perhaps, in some of these emerging markets. There has been a lot of progress in developing local capital markets and local financing in some African economies. Hippolyte, you and I have spoken extensively about this also as part of our work for the Africa Financial Markets Index that we've launched at the IMF meeting several times. And but it's still something that is in progress, and financial globalization has reached a stage where a lot of these markets are very dependent on market access, and a lot of them are thinking twice before they go into any restructuring process because of that. So what do you think, how do you think policymakers should be thinking about this in terms of these trade-offs? Who wants to start? Nasser, maybe you have some views to start.
Sure. I'm going to build a little bit on what Hippolyte was mentioning. But let's look at the dimensions of the problem to begin with. Emerging markets have got something like 730 billion maturing debt in 2020. And they're facing the vulnerabilities that we were mentioning. Lower growth prospects, I mean, because of COVID globally. Export markets are down because trade is down at least some 30%, and that's affected commodity exporters particularly badly, including the oil exporters who are facing very similar problems. Tourism, and that was a source of foreign exchange for many of the countries, is completely dead. So in effect, their export markets are practically non-existent. And on top of all that, you have the COVID supply effect domestically, right? So many countries where if they can afford the lockdown are locking down. So you've got both an external demand shock, an export shock, and at the same time, growth prospects which are really uninviting for most of them. So the question really, when people worry about should I go for debt relief or debt servicing suspension, really the choices are very limited for many of these countries, particularly in Africa. What is your choice? Do I service my debt, or do I keep my people healthy and protect them from COVID? Politically, I mean, the choices are straightforward. You protect your people, otherwise you are not going to survive. Now, if you look at the impact in terms of market access, the credit worthiness is definitely going to be affected. The rating agencies are going to downgrade all the emerging markets, but that is not because of policy actions that the countries took. This is an external effect. This is going to happen independently of any policy action they're going to take, simply because of the COVID effect, right? And I mean, if you look at the rating agencies, they've even downgraded advanced economies because of COVID. So what we're talking about is fiscal sustainability, etc., macroeconomic stability, impact of COVID. So you're not going to avoid that downgrading simply by saying, I'm not going to go for debt relief or debt suspension. So I think we need to facilitate that. And I think what needs to happen is you have to have a greater role for the IMF. The IMF has a number of tools. They've recently had the rapid financing instrument, which they've put out there. We're talking about the increasing the borrowing capacity of the IMF, either through bilateral or more globally. Those are the sorts of things that have to be put on the table so the IMF can play a role. Why the IMF? Because if you're going to turn towards creditors, commercial creditors at the moment, they're going to say, you need to deal with the macro issue, not my particular debt or my particular bond. Deal with the macro issue. Once you've dealt with the macro issue, come and talk to me. So what I think needs to happen in terms of the debt service suspension argument is to say we need intervention at the level of G20 plus IMF and using more instruments. But at the same time, we need to also say to private creditors and ask the countries who are receiving financing from the IMF through various instruments to also impose the same conditions on creditors. And one of the items I think that is important on the purely technical side concerns CACs, collective action clauses. And to come back to the case of Lebanon very quickly, we face the problem that not all our bonds have enhanced CACs in there.
Yes, so Lebanon is actually one of the exceptions in that sense, that it hasn't accepted that thing.
It creates a further problem. So this idea of enhanced CACs is a very important one. So if you're going to restructure and repackage any of the debt, and I think maybe this is the time to start thinking of a Brady plan, like was done in Latin America, in the 80s. Restructure it, repackage it with enhanced CACs, and provide some guarantees. I mean, guarantees can be a very effective way of reducing the cost and restoring market access. So maybe those types of instruments are the sort of things we should be thinking about.
Thank you, Nasser. Hippolyte, over to you to respond. And I think also about the trade-off for policymakers, but also for creditors, because do we maintain this system of a framework for restructuring with enhanced CACs, or do we sacrifice that to sort out the issues now? I think this is a very pertinent debate we're seeing in Argentina right now. And there is a commentary on the ONFEF website today about that by our US chair, Mark Sobel. But it's also a more broader issue about how do we solve the issues now versus maintaining a framework for orderly restructuring in the future? And how do you see that debate or that balance that policymakers have to strike between the market access in the future and restructuring today?
No, thank you very much, Dana. I think I will build on what the minister just said regarding the trade. The first trade-off is the first toning trade-off is the one between addressing the pandemic fallout or meeting their financial obligations, which is a difficult trade-off because if you remember, it's the country is bleeding and policymakers have to choose between transferring the scarce resources that they have for interest payments and providing the needed for the vulnerable populations. And the Ghanaian president is very famous saying recently, we know how to bring the economy back to life. What we do not know is how to bring people back to life. So we know how to bring the economy back to life, but what we do not know is how to bring the people back to life. That is the challenge that those who are in the steering wheel of policy making are facing. But the trade-off you are raising on the issue of restructuring versus meeting and continue securing access to market is the one that many African countries are currently facing. And the trade-off is so real that it's difficult to have a consensual position of all African countries on how to address the looming debt crisis. And some are saying, yes, we need debt relief. Others who still need debt relief are saying, but what about the future? What about the future access to market? And so we have that tension between those who are acting in the short term, who are feeling the burden more than others, and those who, yes, are feeling the burden, but also concerned about market access as a way to sustain growth going forward, post-containment phase. So that challenge is real, and increasingly, and we believe that it's important to bring the IMF in the mix. Many countries have gone to the IMF for that matter, and which will facilitate in this case, because for the most case, in like the European Union, which is actually activated, is actually closed, fiscal close, to allow country to run more deficit. The IMF has been lenient at this time to allow for widening fiscal deficit to enable country to cope with the crisis that we are facing now. But the IMF has also done something very significant, which is to say, instead of just deferring payments to meet the net present value term to creditors, for really vulnerable countries, let's activate the Catastrophe Containment Relief Trust to enable country to actually have real fiscal space. I mean, real fiscal space in the sense that it's not deferred payments. They've allowed more advanced economy, like the UK, for instance, like Japan or China, to contribute grant financing into that trust, which it's enabling them to actually service the debt owed to the IMF without jeopardizing future payment, future commitment. And currently, it's about a 6-month arrangement, but there is a push to have it up to 2 years. 25 countries have benefited from that, of which 19 African countries. It is a big fiscal relief. It is extended over a 2-year period. It will amount to almost $500 million saving for this country combined. So that's one model which will actually provide relief without jeopardizing future payments. Another one put to the table in terms of that trade-off, it's what they call debt suspension initiative, which is essentially a defer payments. In other words, you do not pay anything for 1 year between now and let's say December, but those interest and debt service actually defer to be paid over a 3-year period. That will satisfy the NPV term, which most private creditors are asking for, but will not address the fundamental problem, because if there's not a strong rebound growth in 2021 going forward, then the issue of actually honoring those external commitments will remain real for most of these economies. So it is a challenge that we see. And if you add to that challenge, and going back to what Mr. Minister said, the issue of remittances, and take the African continent, which, let's say 2018, received $85 billion remittances. Among the top 10 recipient countries in the world, you have Egypt and Nigeria. The two combined more than $50 billion. And the pandemic has been a global effect, global shock. The source country, the US, Europe, where the remittances are flowing back into Africa, are under crisis, with unemployment rate reaching double digit in some countries, which means that the 20% shock that we have in the remittances in 2020, which have fallen by over 20%, will actually undermine the prospect of relying on remittances inflow to actually address some of the financial shock crisis that the country are facing. So the alternative, the options are actually very limited for most of these countries, and which call for a sense of understanding and actually debt restructuring, because as we said earlier, the worst scenario is to get to where Lebanon is. Then it becomes very difficult to get out of it, because we do not want to move from an economic crisis to a financial and banking crisis, which become very difficult and longer lasting, which will actually undermine the process of recovery that we are all wishing for. Let me stop here.
Can I just
Thank you. Yes, sorry. Yes, Nasser,
add
very quickly.
one item that we haven't discussed. This is the dragon in the room. The dragon in the room is China.
Yes, I was just going to ask about China, actually, because
China has been directly lending to many emerging markets to the tune of about 1.5 trillion. So
especially in Africa, we've seen an increased role.
Especially in many countries, it's about 20% of their GDP for a whole number of African countries. Now, why is that important? I take what Hippolyte is saying right on the spot. What we want is debt relief, really, because the pandemic, COVID, is likely to be with us for a much longer period. I don't see recovery very quickly. And therefore, if we just give them a debt service suspension during 2020, it's not going to really resolve the issue. So you're going to have to think of debt relief for a longer period. But the second one is China. You need to bring China to the table. That's going to be critical for many countries in Africa and across the emerging world. And there has not been really an engagement with China on the issue of debt relief and suspension of debt service. That has to come very quickly, in my view.
Yes, no, absolutely. And I think we also have this in a very changed geopolitical environment now, where we're seeing tensions among China, the US, and multilateral institutions. And China, of course, is part of the G20 that agreed this plan for debt forgiveness that we saw a few months ago. So how do emerging markets get caught up in between these tensions? I think would be a question to ask, and how this is relevant for Africa. But maybe before I hand the floor to you, just to remind the audience that you can send through questions to the chat function and through emails. We have about 10 minutes left. So start sending us your questions and we'll try and answer them in the remaining time. But very quickly, maybe any thoughts from you, Hippolyte, on the China issue, responding to Nasser and what I've just raised as we start gathering the questions.
The dragon in the room, as the minister lyrically put it, the dragon is actually in a very big room, and that room is the world. And I think China landing on the Belt and Road Initiative is all over the map. And yes, they play a major role in some African countries, especially in the space of infrastructure development. You've seen a lot of transformation in Ethiopia, for instance. You've seen the China hands in building railways in Nigeria and in Southern Africa, and they play a major role in the infrastructure space. But when we look at the distributions of Africa's debts globally, external liability, and yes, China is a recent factor which has been highly visible in the infrastructure space. But when you look at the stock of debt aggregate, it's actually less than 10% of total Africa debt as we speak, although rising last decade. And what is currently driving Africa debt significantly, as earlier, is essentially the bond access to capital, and which, as we move away from the zero lower bound interest rate environment into increasing, hiking up, and the risk of that debt sustainability will become even more important. Yes, it is important to bring all potential creditors to the table, and the fact that China agreed to contribute to the IMF Catastrophe Containment Relief Trust, it's a positive in that sense, that it will provide relief to some of the country. But I think going forward, it's very important to show that whatever is agreed is not achieved at the expense of growth. More than any other regions, Africa needs growth, and perhaps is look at the golden rule. How do we make sure that the concession to the increased external liability is actually tied to productive investment? And that is key to really sustain the growth momentum that Africa needs to continue to be a player and to close the gap, the welfare, and you made the welfare gap, capital gap between Africa and the rest of the world. It's very important to make sure that we continue to sustain the investment which are leading to economic growth and strong growth. Africa should be growing at more than 5-6% a year. And we hope that the step taken by the regions to establish free trade area agreements will not be jeopardized by the current debt negotiations, because more than at any time in the past, we need strong investment in manufacturing infrastructure to drive the process of economic transformation and boost intra-African trade. So those are considerations that we think should be on the table as we negotiate this transition.
Thank you. Yes, I think you've hit the nail on the head also about what Nasser was talking about earlier about the conditionality and reforms, and how do we grant debt relief and plan debt restructuring now without sowing the seeds of the next crisis tomorrow. And there's also some plans that talk about how we can attach sustainability objectives to the money that is given for debt relief, and how can we attach transparency objectives? What forms could conditionality take to also make sure that the recovery is sustainable? And this is something that we're seeing not just in emerging market debt restructuring, but also in the state aid that being offered even in Europe here to companies that are being bailed out or that are being supported. For example, the airlines that are being asked to cut their carbon footprint in order to get this government money, or the executive pay and bonus payments that are being asked as conditions to support companies. So we're really seeing that drive for more ESG type of recovery as a result of that. I have two questions from the audience, and we're coming towards the end, so let's keep our answers brief so that we can answer all of the audience's questions. But one for you, perhaps, Nasser, is what do you think about the initiative that is driven by the G20 and the Paris Club of Service Relief? Because some stakeholders are against such a general approach and would prefer a case-by-case analysis. I think that also you could build on what you were talking about, the single limb CACs and the enhanced CACs there, and how we can have a more individual approach versus a more general. And then a question for you, Hippolyte, about South Africa in particular. That's the questioner here is asking about the debt markets that are structurally strong. Government debt is mostly in local currency. So how can countries with perhaps stronger debt fundamentals use capital markets to support public borrowing? And I think you talked a little bit about the IMF, different facilities, and the IMF also recently launched a precautionary lending facility for countries with stronger fundamentals, and how they can access funding without actually resorting to the IMF with the strings attached, or perhaps the stigma effect. So a question about countries with stronger fundamentals and accessing capital markets, and then a question to you, Nasser, about the G20 plan. So Nasser, do you want to go first? And let's keep them brief, because we have more questions coming.
The importance of the debt service suspension proposal, G20 and related, is that it allows you to aggregate, right? If you're going to start disaggregating and start negotiating bond by bond or series by series, it is extremely costly. We need to remember that. I mean, both in terms of time, but also in terms of expenditure that you're paying to various advisors, legal and other side, on both sides. Both the country itself and the creditors. There's also one further element which complicates it, which we didn't discuss. We talked about globalization earlier. And one aspect of globalization is the increasing use of bond funds, right? So we now have bond fund investors going up and buying bonds. In the case of Lebanon, we got the case of Ashmore, which is an emerging market investor, which went into Argentina, Ecuador, and Lebanon and burnt its fingers very badly. It tried to build up a blocking stake. Now the funds are not used to these restructuring discussions in the same way as the banks are. So if you look at the IIF, which has the bank constituency, we know how to talk to the IMF, and they have a long history of dealing through Paris, through other mechanisms with debt restructuring. Bond funds in their variety don't have that experience. They're a new actor, and that, I think, complicates it. So we need to insist on the single limb CAC, and aggregation. That's extremely important because it saves costs on all sides, but also delivers much better outcomes. Because if you want to try to calculate NPVs and you want to try to be neutral in any way, think of trying to do that on a single series, on a bond, etc. That doesn't make a great deal of sense. You need to look at the macro picture, not on a single bond or single series.
Thank you. That's a clear view. And then over to you, Hippolyte, about the South Africa question. And then maybe I'll add two questions to that because they're related and you can have the final word. So the question was from the South African Treasury on the South African stronger fundamentals. I also have a question about the African Union proposal and the UN Economic Commission for Africa, about a special purpose vehicle for an exchange of sovereign debt for new concessional paper. If you know anything about that, where we are on that, what the plans with it are. That's a question from Christina Lascaridis from SOAS. And then also a question about how can the United Nations Conference on Trade and Development help and support debt relief and liquidity initiatives. So because you've spoken about the different institutions, that's a question from Stephanie Blackenberg from UNCTAD. So 3 questions for you, Hippolyte, and then I'm afraid we'll have to cut off for today. We could go on for quite a long time, but any answers to those?
Thank you very much. I think on the first one, it's what UMFIF has been pushing to a certain extent. Yes, within the continent, the fact that the South African capital market is deep and liquid, highly liquid, has actually enabled the South African government to rely more on domestic debt than external debt, which is quite a contrast with country in the rest of the continent. And it's an important part. And one way forward is to move towards an increased integration of capital market within the regions to deepen these markets and allow more countries within the region to rely on local currency financing and reduce the risk that we raised earlier as a way of actually mitigating the growth of external debt burden that we currently facing across the regions. On the special purpose vehicle, it's one option which has been proposed to really reconcile both those who are for debt service suspensions and those who are for debt forgiveness, but also committed to the market. And how do we make sure that we provide breathing room, fiscal space to countries without undermining their access to the market? The SPV will enable to achieve both, in the sense that it will not only aggregate into one bucket, which could be sold at a special price without undermining the net present value neutral, but also ensuring equity in the treatment of different creditors. That's what the SPV will actually achieve. But I wanted to also stress one important factor that we did not really discuss very much in the context of this exchange. In the last IMF Economic Outlook, there was a published in April during the spring week, there was a very interesting statement, essentially saying that countries which have access to reserve currency status, the US dollar and the euro, will manage the crisis better than those that did not have that status. Essentially, as the minister said, there are some who can finance their deficit and address the pandemic fallout without concern about external creditors. And there are those who actually will not do that, who have difficulty doing that, because they do not yet enjoy the exorbitant privilege of reserve currency, if we go back to Giscard. And the key question, therefore, for a growing number of these countries is, how do we make sure that we transform African economies to reduce the dependency on commodities, which has been associated with rising external liabilities? I think this is where the African Export-Import Bank comes into play in supporting the growth model that is actually pushing for industrialization across the regions. And the pandemic, to that extent, has been an opportunity. We are working with a number of manufacturers to start producing personal protective equipment and other medical and drugs in the continent to reduce our external commitment, external exposure in the pharmaceutical, which is about $16 billion a year of import of pharmaceutical goods. Let me stop here.
Thank you very much, Hippolyte. I think we could have gone on for much longer, more questions coming in about Lebanon and how it could go out of the crisis, but we'll have to stop here, I'm afraid, and perhaps we can have a follow-up session. I'm sure this issue will continue to be very important for months to come, so we would definitely welcome you back to an UNCTAD seminar about this. Very, very good to have you on the line with us today. Thank you for your time. Thank you to the audience for your brilliant questions. And this will be up on our website in case you want to send it to others to watch that are interested in this topic. Thank you very much and have a good rest of your day.
Thank you for
inviting us.